Okay, so let's start with question number 9 now. Question number 9. See, Ramdin, aged 33 years, meaning not a senior citizen, working as a manager sales with Frozen Foods Limited, non-government employee, provides the following information for the year ended 31st March 2025. Basic salary 15,000 into 12, 1,80,000 taxable. DA 50% of it is meant for retirement benefits. So can I say 12,000 is a DA, meaning 1,44,000 will be the DA, but out of that only half is in terms, okay. Turnover of the company is 50 lakhs and 0.5% is the turnover commission. So 50 lakhs into 0.5% will be 25,000 turnover commission. 25,000 turnover commission also taxable. Bonus 50,000 taxable. Then 30,000 gratuity also taxable. Sir, why did you tax the gratuity? Simple. If he is not retiring, question is not saying about his retirement, meaning this gratuity is not a death cum retirement gratuity. This gratuity is received while he is in service. Okay. So any gratuity while you are receiving while you are in service, that is fully taxable. Okay. Own contribution to RPF. For this he is going to get deduction under ATC. Okay, for this 30,000. So let me highlight this. Own contribution to RPF 30,000. Next one. Employer's contribution to RPF 20% of basic salary. Can you calculate the 20% of basic? So 1,80,000 into 20% will be 36,000. So employer is contributing 36,000. 20% of basic salary is 36,000. Now he should contribute 12% of his salary, if you remember. Maximum contribution by the employer to the RPF account of the employee should not be more than 12%. Do you remember that? 12% of what? Salary. Basic DA in terms turnover commission. So basic you have 1,80,000. DA in terms you have 72,000 only. Don't take 1,44,000. Okay. And turnover commission is 25,000. 2,77,000. Take 12% of that. So can I say employer's contribution to RPF to the extent of 12% of 2,77,000 will be 33,240. Now how much is employer contributing? 36,000. Is he contributing more? How much? That excess 2,760 will be taxable as your salary. Interest credited at 15% it is 15,000. So at 12% it should be 12,000 only, no? If at 15% it is, sorry, at 9.5%, at 9.5% it should be 9,500 only, meaning that the employer is contributing more as well as interest is also credited more than the required amount. How much was required? 9,500 was required to be credited. If 15% is 15,000, how much should be 9.5%? It should be 9,500 only. So any excess contribution over and above 9,500, that is amounting to 5,500. Yes or no? So that 5,500 excess interest credited will also be taxable. Next one, gold ring worth 10,000 was given by the employer, 25th wedding anniversary, gift from employer in kind. If the amount is more than 5,000, then two things can be done. If you want to tax, you can tax the full amount also, you can tax the amount in excess of 5,000 also. What will do? We'll tax the entire 10,000. Yes or no? Next one, music system purchased on 1st April 2024 by the company for 85,000 and was given to him for personal use. Use of movable asset, 10% per annum of the actual cost of that movable asset will be treated as your benefit. So music system is a movable asset, everyone. and given to you for use. So what will be your benefit? 10% per annum of the actual cost, 85,000. 10% of that will be 8,500. That will be your benefit. Getting my point? And since nothing is mentioned, we will assume that the day on which it was acquired, on that same day it was given for use. Meaning you are using it for full year. So full year benefit is what? 8,500 taxable fully. Hello? Now, can you calculate this total? Calculate the total salary. It will be 1,80,000 plus 1,44,000 plus 25,000 plus 50,000 plus 30,000 plus 2,760 plus 5,500 plus 10,000 plus 8,500. 455,760. Getting this or not? Please check this answer once. 455,760. We have not forgotten anything, no? We have taken basic also, we have taken DA also, commission also, turnover commission also, gratuity done. Then own contribution we will consider under 80C. Employer's contribution 2,760. Perfect. 2,760 also we have taken. And then interest rate at 5,500 also taken. Gold ring also taken, and 8,500 also taken. 455,760. Yes. And out of this 50,000 standard deduction. So it will be 4,05,760. This will be your taxable salary. Okay. If you are not following 115 BSE, yeah? And if you are following 115 BSE, then there will be a little bit change. In the end, we are going to see. Okay. Check only, no? Option to shift out. So he is shifting out. So this is correct. Okay. Next one. Now, 2 old light goods vehicles owned by him were leased to a transport company against the fixed charge of 6,500 per month. Books of accounts are not maintained. See, if you don't maintain the books of accounts of your goods transport business, then you have to compulsorily show presumptive income under 44AE, which has to be 7,500 per month or part of the month's ownership of the vehicle. Light goods vehicle, then it is 7,500. If it is heavy goods vehicle, then 1,000 per month or part of the month's ownership. 1,000 rupees per ton of the gross vehicle weight you will have to show. But this is not a heavy goods vehicle, so you will have to show 7,500 per month or part of the month's ownership. Okay, no? Or more amount you are supposed to show. Then don't maintain your books, don't get them audited. You cannot show lower amount. If you want to show lower amount, maintain the books and get them audited also. But if you are not maintaining your books, minimum 7,500 per month for each vehicle you are supposed to show. How many months ownership of vehicle is there? Nothing mentioned. So we will assume both the vehicles owned for 12 months. And for both the vehicles, minimum 7,500 per month we have to show as income under 44AE, presumptive income. So we will show 44AE. We cannot show 6,500. Why? Because books of accounts are not maintained. So under 44AE, 7,500 per month into 2 vehicles into 12 months. How much you are getting? 7,500 into 2 into 12. You are getting 1,80,000. This will be your PGBP income. PGBP income, one business, transport business income. Okay. Now you are receiving, this is important point. You are receiving interest 5860 on bank FD and interest of 6786 net from debentures of Indian companies. Now 2 interest you are getting. One interest on bank FD you are getting, that is a gross amount. So this gross amount will be taxable under the head IFOS. And for this you are not going to get any deduction under ATTTA, because under ATTTA you get the interest from savings account. So you could have got this interest as a deduction under ATTTB. But for that you should be a senior citizen. Since you are not a senior citizen, so you cannot claim this interest as a deduction under ATTTB also. So no ATTTA, no ATTTB for this interest. This entire interest, gross amount will be taxable under the head IFOS. Okay, now please pay attention. The interest is net from debentures of an Indian company. See, there is one section, no, in TDS, there is one section, section 193, that talks about interest on securities. So when you will do that section, no, in that section it is given that we are very soon going to start with that section also. Okay, no, in TDS chapter, the second or third section is that only which we are supposed to do. So in section 193, it is said that when a resident gets interest on securities like interest on bonds, interest on debentures, etc., yes or no, interest on government securities. So when you are a resident and if you are getting interest on securities, so the issuer, the person who has issued those securities, is going to give you interest. So that person is going to deduct TDS under section 193 at the rate of 10%. And specifically, if it is interest on debentures of a public limited company, no, which you are receiving by way of account pay check, your individual HUF receiving that interest through account pay check on the debentures of a public limited company, then that debenture is more than that interest is more than 5,000, then the TDS will be deducted at 10%. So can I say, if net amount coming to you on the debentures, if that net amount itself is more than 5,000, definitely the gross amount would be more than 5,000 only. So some interest was there which you were supposed to receive. Out of that 10% TDS is deducted and this net amount is given. So can I say this net amount is your 90% amount? And under the head IFOS, you don't have to show net, you have to show gross. So you'll have to do the grossing up. So if this amount is 90%, how much should be? 100%. Can you cross multiply? This is 6786 divided by 90 into 100 will give you 7540. So this interest will also be taxable under the head IFOS, but 7540 and not this amount. Okay. And when you will charge this interest under the head IFOS, please remember that the TDS was deducted from here. And that TDS, when you will calculate the tax liability, at that time you have to take the credit of this TDS. Okay, no? Now please pay attention. That FD is there, no? FD interest. On that FD interest, 194A TDS would have deducted if that FD interest is more than 40,000. In case of senior citizen, the limit is 50, but in case of others, the limit is 40. You are going to read all these limits. Don't worry about it. But just now, whatever I am telling you, please try to remember. Okay. Whenever you get FD interest now from any bank, okay, that interest for the full year, if that amount of that interest is more than 40, then only the TDS is deducted. And if you are a senior citizen getting FD interest, then for you the FD interest is more than 50, only then the TDS will be deducted. Now just to see how much gross interest you are getting. Is it more than 40? No, no. Hence no TDS is deducted. If this amount would have been more than 40, no, then definitely from here also 10% TDS would have been deducted. So this gross entirely taxable, no TDS was deducted from this because there was no requirement of deducting TDS out of this. And from debentures, TDS would have been deducted under section 193, 10%. So the net amount which you are getting is 90% only. Gross it up, make it 100%, and that 100% will be taxable under the head IFOS. Will you remember 7540 you are getting, everyone getting this? Okay. Now, made payment by check 15,370 towards premium on life insurance policy and 22,500 for mediclaim insurance policy for self and spouse. So this 15,370 you are going to claim under ATC and 22,500 you are going to claim under ATD. This is just premium amount. Okay, no? Assuming that they are within the limits, so these will be allowed. ATC full 15,370 will be eligible and ATD full 22,500 will be eligible. Okay. Investment in NSC 30,000. And FDR of SBI, FDR means fixed deposit. Do you remember, with any scheduled bank you keep a fixed deposit for a period of 5 years or more. The whatever amount you deposit in that FD for a period of 5 years or more, for that amount also you are going to get what? ATC deduction. So ATC deduction you are going to get for this also, ATC you are going to get for this also. Now have you identified ATC? 1, this is 2, and this is 3, and one more ATC you have identified above. Can you see? Own contribution to RPF. These 4 amounts will come in ATC. Okay. So can you calculate the total ATC? Can you calculate the total ATC? This will be 30,000. Then add 15,370 plus 30,000 plus 50,000. It will be 125,370. So the deduction under ATC you are going to get, ATC deduction you are going to get 125,370. And under ATD how much you are going to get? 22,500. Only one thing is there, no? Only one mediclaim is there under ATD. 22,500. Any other thing under mediclaim? No. Perfect. Now ATC is there, ATD is also there. Now donation of 11,000 to an institution approved under ATG and 5,100 to Prime Minister's National Relief Fund were given during the year by check. Very good. So donation of 11,000 to an institution approved under ATG. If nothing is mentioned, it will be approved for charitable purpose only. Category D. Okay. And Prime Minister's National Relief Fund, meaning category A. So A category, this 5,100 will be fully allowed. But D category, we will have to see C plus D both taken together. C is nil, D is 11,000. So 11,000 should not be more than 10% of adjusted total income. But first I will have to calculate the adjusted total income. For that the entire question needs to be solved. Hello sir. Till that time I will not be able to calculate this ATG. Getting my point? Now pay attention. See, broadly we have discussed this entire question properly. Okay. Now tell me, what will be your income from salary? Have you calculated your income from salary? Yes, entire income from salary we have calculated. It is 4,05,760. So 405,760. Income from house property. Do you have any income from house property? No sir, there is no income from house property. It is nil. Do you have PGBP income? Yes, under section 44AE you have calculated what? The presumptive income of your transport business amounting to 1,80,000. Yes or no? Capital gain do you have? No capital gain sir, nil. And income from other sources you are having how much? See, income from other sources you are having FD interest, no? 1 FD interest and 2 debenture interest. Any other income you are having? No. So 5,860 plus 7,540, 13,400 will be your IFRS income. Any other income? No sir. Got it everyone? This 4,05,760 plus nil plus 180 plus nil plus 13,400. Calculate the GTI. Gross total income. $5,99,160. Got it sir? So let's check before we move ahead. Okay. 599,160. We are also getting it or not? This was your question number 9, no? See, salary is 4,05,760. We also got 180. PGBP also we have got, and 13,400 we also got. So GTI we are getting 599,160. Everyone? Okay. So this was your GTI. Now pay attention. Out of your GTI, are you going to get chapter 6 deductions? Yes, absolutely I am going to get sir. So ATC ATC, how much you are going to get? 1,25,370, no? 125,370. ATD, how much you are going to get? 22,500, sir. Done, sir. And the last deduction is ATG. So for ATG, what I will have to do now? I will have to take my GTI on my calculator. Any LTCG 112 in this? No. Any STCG 111A in this? No. Just reduce all the deductions except ATG. That is not there only, no? So reduce 1,25,370 and reduce 22,500. 4,51,290. That will be your adjusted total income. Yes or no? And 10% of that if you will do, you are going to get 45,129. So C plus D both taken together cannot be more than 45,129. Hello sir. C plus D, category C donation, category D donation, both the donations taken together cannot be more than 45,129. Sir, they are not more than 45,129. C is nil, D is only 11,000. So entire 11,000 will qualify under ATG. But that 11,000 is from category D. Will be allowed fully or only 50%? Only 50%. And category A is how much? 5,100 will be fully allowed. Got it? So under ATG, how the calculations are made? Did you understand, everyone? So ATG, 5,100 from category A and 5,500. This is half of 11,000 which was qualifying under ATD. Sorry, under ATG, category D. So this will be 10,600. So do one thing, 599, 160 minus 125, 370 minus 22,500 minus 10,600. You are going to get 4,40,690. My dear friends, this is your total income. Are they telling you to calculate the tax liability also? Total income and tax payable. Can you see? So now you will have to apply what rate? What rate? Normal rates only. Because entire total income is normal. No special income is there. Okay, no? So apply the normal rates. Tax will be on the first 2,50,000, it will be nil. Then total income over and above 2,50,000 up to 5 lakh is 196.90. On that you will apply 5%. So you are getting 9535. Okay, so your tax will be 9535. Are you going to get any rebate? Yes sir, I am going to get rebate. How much? 9535 or 12,500, whichever is lower. So 9535 you are going to get rebate. So what will be your tax liability after rebate? It will be nil. Add 4%. So gross tax liability will be nil. But wait, was there any TDS deducted? That TDS you will reduce from here. So how much TDS was deducted? 7540, 7450 or 7540? It was 7540. 7540 into 10%, 754 rupees TDS was deducted. Hello sir. Any other TDS deducted? Please check. Any advance tax? Any TDS? No, na? Only 754. Only one TDS is there in the question. That TDS you reduce. So from nil, if you will reduce 754 TDS on interest on debentures, yes or no? So you are going to get a refund of 754. You have to round it off. Refund of 750. This refund you are going to get. Got it, sir? Very difficult? Easy question. See, many informations are given in the question, no? That's why students get confused. Don't get confused. All the questions are easy. You are going to get the same things which we have done in the class. See, 750 refund. Tax refundable. Okay, no? Should I move ahead with the next question? 9th is done. 10th was given as a homework or not given as a homework? Homework also you have not done. 100% you have not done the homeworks. 10th question was not given as a homework, no? Okay. From the following particulars furnished by Mr. X for the year ended 31st March 2025, you are requested to compute his total income and tax payable. So total income, tax payable both. Assuming that he opts out of the default tax regime, meaning he is not following 115 BAC. Because of this 115 BAC, no, things have become more complicated now. Okay. See what you are supposed to get, what you are not supposed to get. When you are following 115 BAC, when you are not following 115 BAC. So that thing needs to be, kept in mind, and constantly you should be alert. That if a little bit mistake happens, the entire question can go wrong. Okay, entire solution can go wrong. So that will be, slowly and gradually you will be developing. Earlier, no, when 115 BAC was not there, no. At that time, these questions were very easy, because you did not have to recollect what is there in 115 BAC, what is not there in 115 BAC. So Madam Nirmala Sitharaman, when she brought 115 BAC, that time her budget speech was, we want to make taxation simple for common man. See, we are common man only. And how simple she has made. It was introduced in 2020, yes. Okay. Earlier it was not default tax regime. Earlier it was optional. So people were not opting. Last year only they have made it default. Now if you want to follow normal, you will have to come out of default. You will have to shift out. Earlier this was optional. 115 BAC was optional. You can take 115 BAC, but normal is this only. So everyone was going with normal. Nobody was following 115 BAC. Very less people were opting for 115 BAC. And Madam is, very adamant. She wants everyone to follow 115 BAC. Because she has given her heart and soul for this 115 BAC section. And she wants everyone to follow it. So nobody was following, she got hurt. So last year only she made it compulsory. Now this is default. Now if you want to follow normal, shift out. Take the option of shifting out. If you don't take that option, this is normal. This is default. Getting my point? Now pay attention. Mr. X retired on 31st December 2024 at the age of 58, meaning that he is not a senior citizen and his employment is only for 9 months. So whatever salary etc. you will calculate will be from April to December, 9 months only. Okay. Next one. After putting 26 years and 1 month of service, meaning that this is years of service. These many years he has worked with the employer. Okay. At a private company in Mumbai. Okay. He was paid a salary of 25,000 per month and HRA of 6,000 per month. He paid rent of 6,500 per month during his tenure of service. So can I say salary 25,000 he is going to get for 9 months only? So 25,000 into 9 will be 2,25,000 salary taxable. 2,25,000 salary taxable. Then he is getting HRA 6,000. So from that HRA, is he going to get any exemption? Yes, because he is not following 115 BAC, his HRA will be exempt. So tell me how much exemption he is going to get? 6,000 HRA he is getting per month. So he is going to get it for 9 months only. Yes, 54,000 HRA. Out of that 54, how much will be exempt? A, B, C, whichever is lower. A, 54. B, 50% of salary. 50% of salary will be 2,25,000. Only basic is given. DA in terms, turnover commission, etc. not given. Understanding? So 2,25,000 divided by 2, meaning 50% of salary. Why 50%, sir? You could have taken 40% also, no? Staying in Mumbai, no, metro city. So 50% of salary. So it will be 1,25,000. Sorry, 2,25,000 divided by 2, 1,12,500. Okay. Then limit C will be rent paid 6,000 into 6,500 into 9. Rent paid is 58,500. And out of that minus what? 10% of salary, 22,500. Okay. So 36,000 will be limit C. 54,000, 1,12,500 or 36,000, whichever is lower. 36,000 is lower. So out of the HRA 54,000, 36,000 will be exempt, and how much HRA will be taxable? 18,000 HRA will be taxable. I hope you understood how did we calculate this. Okay, now I need not show you the calculations. Everything should be here. Okay. Now he was paid salary. Okay, done. On retirement, he was paid gratuity of 3,50,000. So can I say this is not gratuity while he was in service? This is a gratuity on retirement, death cum retirement gratuity, and he is covered by what? POGA also, Payment of Gratuity Act. So do you remember under POGA, when you are covered and you are given the gratuity, your gratuity is exempt. A, B, C, whichever is lower. A, actual gratuity. B, maximum 20. And see, that 20 lakh limit will be reduced if you have already claimed gratuity exemption earlier. So in this question they are saying X had not received any other gratuity at any point in time earlier other than this gratuity. That means his 20 lakh limit is intact. That is not changed. 20 lakh will remain 20 lakhs. Okay, no? If you would have taken gratuity earlier and he would have claimed the exemption of the gratuity earlier, then his 20 lakh limit would have been reduced by that amount. Getting my point? So 20 lakhs. So first is actual gratuity 3,50,000. Second is maximum 20 lakhs. And third limit will be 15 by 26 into last drawn salary per month into number of years of service. And in the number of years of service, any fraction of the year, if it is more than 6 months, then it will be also considered as a full year. Sir, fraction of the year is 26 years and 1 month. 27th year I have started working. But in the 27th year, am I working for more than 6 months? No. So ignore 27th, take only 26. So 15 by 26 into 26. Hello? Into last drawn salary was 25,000 only. Can I say 25,000 into 15, it will be 3,75,000 divided by 26 into 26, you are going to get 3,75,000 only. Hello sir, 3,75,000 or 20 lakh or 3,50,000, whichever is lower. 3,50,000 is lower. So 350 minus 350, how much gratuity will be taxable, sir? It will be nil only. Understanding? Now, he had accumulated leave of 15 days per annum during the period of his service. Accumulated leave 15 days. Accumulated leave means leave allowed minus leave taken, leave saved, leave credit. They are talking about 15 days leave credit. So every year, on an average, he is saving how much? 15 days leave. 15 days, 15 days, 15 days. Okay. Now, this was encashed at the time of his retirement. Can I say leave encashment is happening on retirement? And leave encashment, how much he is getting? 3,15,000. So for this, he is going to get exemption under 10(10) AA. 10(10) AA. How much exemption he will get? A, actual amount 3,15,000. B, maximum 25 lakhs. Do you remember? Leave salary exemption is 25 lakhs, no? Maximum. So 25 lakhs. So either the actual amount 3,15,000 or 25 lakhs, or C will be 10 months salary. And average salary for this purpose may be taken as 24,500. Please be very careful. They have themselves calculated the average salary for HRA for this exemption. Yes or no? So if you are going to take any other average salary, your answer will be wrong. They have only calculated average salary. So for your exemption, take this average salary only. Okay. So 24,500 into 10 will be 2,45,000. 10 months salary. Do you remember the 4 limits? actual amount maximum 25 lakhs, 10 months salary, or leave credit multiplied by average salary. So limit A, actual amount 3 lakh 15. Limit B, 25 lakhs. Limit C, 10 months salary will be average salary into 10 will be 2 lakh 45. Now you have to calculate the leave credit. Leave credit as per employer's rules or leave credit as per IT rules, whichever is lower. Leave credit as per employer's rules and leave credit as per IT rules will be same, because employer is allowing how many days? 30 days leave per annum. And how much? IT rules is also allowing 30. So as per IT rules, whatever will be there, that will be same as that of employer's rule, no? So how many leaves employer was allowing? 30 multiplied by 26. So 30 every year he was allowing. Out of that, every year he was saving how much? 15. Meaning he was taking 15, saving 15. Taking 15, saving 15. So whatever he has saved for 26 years, no? Every year 15, 15, 15. So 26 into 15 will give you 390 days. And that 390 divided by 30, you are going to get 13 months leave credit. Did you get 13 months leave credit? So leave credit 13 months into average salary per month. 24,500 into 24,500 will be 3,18,500. Now do you have all the four limits? 3,15,000, 25 lakhs. Then third limit is 2,45,000 and the last limit is 3,18,500, which you have just now calculated. Which is the lowest amount? 2,45,000. So out of your 3,15,000, 2,45,000 will be exempt. 3,15,000 minus 2,45,000, you are going to get 70,000 taxable leave salary. Everyone got this? Yes, sir. Pay attention. After retirement, he ventured into, see, now the details of his salary are over. So can you calculate his salary income directly? Yes. 2,25,000 plus 18,000 plus 70,000, 3,13,000 will be his salary. Is he following 115 BSc? No. So he is going to get 50,000 standard deduction. So minus 50,000 will be 2,63,000. Yes or no? All the payments we have seen, no? 2,25,000 we have taken. Then we have taken HRA. HRA is taxable 18. Okay. Gratuity 350 fully exempt. Then leave salary. Leave salary 70,000 taxable. Yes, we have taken all these things. 3,13,000 minus 50,000. So you are going to get 2,63,000 as your taxable salary. Okay. Now this is your taxable salary. Now you are also having a textile business. After taking the retirement, no, in this year you started your textile business and within 3 months you have incurred a loss of rupees 80,000. Ayyo. Can your loss of textile business, loss of your normal business, can it be set off against your salary? It can be set off against other incomes, but not against salary. And other incomes you don't have. So can I say this 80,000 loss will be directly carried forward as per section 72 to the subsequent year, because it cannot be set off against salary income. So how much is your salary now? 2,63,000. Everyone? Wait. 2,63,000 is your salary. Any other head? No. Last one, X deposited 1 lakh in PPF. For that he is going to get deduction. How much? Entire 1 lakh under 80C. So 1 lakh rupees he is going to claim as a deduction. See, there was no other head. So my GTI will be same, 2,63,000 only. Getting my point? Take 1 lakh. Now it will be 1,63,000. That will be your total income. Okay, sir? Are they telling you to calculate the tax liability also? Calculate the tax. Come on. It will be nil only, no? Why? because the total income is less than basic exemption limit. Please check. This was which question? Question number 10, no? Hmm. 2 lakh 25, 18,000, nil, 70,000, 3 lakh 13, 50,000, 2 lakh 63,000, then 2 lakh 63,000, 1 lakh rupees is what? Standard 1 lakh rupees is ATC deduction, 1 lakh 63 total income. And what is the tax? Nil. Since the total income is less than basic exemption limit, the tax liability will be nil. Okay, sometimes you can get such easy questions also in the exams. If such kind of question will be there, it will be for 6 marks. Will you be able to do it? Sure, no? Okay. Now, come to the 11th sum. 11th sum, Rosie and Mary. This question was asked in the exam. This is your exam question. Okay. And very, very, very good question. This will test you properly. And this was for, if I'm not wrong, this was for 10 marks. 10 marks question. See, Rosie and Mary are sisters born and brought up in Mumbai. Rosie got married in 1982 and settled at Canada since 1982. Mary got married and settled in Mumbai. Both of them are below 60 years. Are they telling you that Rosie has come to India, stayed for these many days? Mary has left from India? Are they telling you? If they are not telling you anything, meaning Rosie was outside India since 1982, this year she has not come to India for a single day. What will be her status? Non-resident. Mary, who is already settled in India, in Mumbai, after her marriage, if nothing is mentioned that she has left India, meaning for the full year she is in India only. And in the past also she was in India only for full year. So her status will be ROR. Okay. So Rosie, what is the status of Rosie? Her status will be non-resident. And what is the status of Mary? ROR. Now whatever incomes which are there, no, now these incomes taxability you will determine on the basis of this residential status. For example, first income is pension received from state government. Who is receiving that? Mary. Mary is receiving, no? So pay attention. This entire pension which he is receiving from the state government, Indian income, taxable for her. If this would have been received by Rosie also, no? Indian income, then also taxable for her. So this entire pension will be taxable as income from salary. As income from salary for Mary, and from where she is going to get a standard deduction of 50,000. Only 10,000 will be taxable because this pension will be taxable under the head salary. So from this pension she is going to get the standard deduction also, no? This is the only income which she is receiving as her salary. There is no other salary income, meaning this entire amount will be her taxable salary. Out of that she is going to get 50,000 standard deduction, not following 115 BSE. Please look at the last line. Both exercise the option to shift out, meaning both are not following 115 BAC. Everyone. So if you are not following 115 BAC, your salary income, you are going to get standard deduction of 50, no? So for Mary, how much will be taxable? 60, no. 10,000 will be taxable because 50,000 will be standard deduction. Yes or no? Now tell me, pension is received from Canadian government. Oh my God. And who is receiving this? Rosie, a non-resident receiving a foreign income. Will it be taxable in India? No. So cross. This will not be taxable for her. Okay. Next one. Long-term capital gain on sale of land at Mumbai. Land is at Mumbai. And when the land was sold? 15th May 2024. Prior to 23rd July. So this is the long-term capital gain covered under section 112 and taxable at what rate, friends? It will be taxable at 20% rates. If the transfer would have taken place on or after 23rd July, then for resident individual, there is an option to pay tax without indexation long-term gain 12.5%, with indexation long-term gain 20%, whichever is lower. But that option is not available for non-resident. They can exploit this point here also. Getting my point? While calculating your tax liability. Now they will just change the date of transfer. Instead of 15th May, they would have given you 15th of August. Meaning the transfer is made on or after 23rd July. So whatever long-term gain is there on that long-term gain is without indexation. Getting my point? And then they would definitely give you the details to calculate long-term gain with indexation also. Yes or no? Definitely 100% they are going to give you. Calculate the long-term gain with indexation for resident, Mary. Because there you are going to get that option to pay tax at 20% also. Because she is a resident. Hello? But if you make such calculation for Rosie, your calculations will be wrong. A non-resident doesn't get that option to pay tax at the rate of 20% on long-term gain with indexation. Getting my point? She will have to pay without indexation 12.5%. But here no, we don't have to discuss all such things. Why? Because the transfer was made prior to 23rd July. The gain is calculated after indexation only. That entire gain is taxable at 20%. Okay, sir? Okay. Now pay attention. This 1 lakh also taxable for Rosie and this 1 lakh also taxable for Mary. This will be long term. Now short term capital gain on sale of shares on 23rd April 2024. See, the transfer is made prior to 23rd July. So can I say shares of listed company sold on recognized stock exchange and short term gain, STT paid short term gain covered by 111A. Short term gain 111A. And on this short term gain, now the rate of tax is 20% if the transfer is made on or after 23rd July. But if the transfer was made prior to 23rd July, that time the rate was only 15%. So we are going to apply 15%. So can I say this is short term capital gain under section 111A and taxable at what rate? At 15%. Why we have done 20% over here? Because this date is there. Why 15%? Because this date is here. And this short term gain is also taxable for both of them. Because Indian companies shares are sold, whatever gain is coming, that is always your Indian income. Even if your status is non-resident, it will be taxable for you. Yes or no? Now, LIC premium is paid. Are you going to get deduction under ATC? Yes. So, Life Insurance Corporation, LIC premium, ATC will be allowed to Mary. Now, premium paid to Canadian Life Insurance Corporation at Canada. And who is paying this? Rosie, who is a non-resident. Will she get any deduction for this premium under ATC? Why? Because premium is paid outside India to outside foreign life insurer. See, if you have done this now, you have committed the mistake like others have done in this question. This was deliberately given. Do you remember ATC? Can the deduction of ATC be claimed by resident as well as non-resident? So even the non-resident can claim the deduction under ATC. Do you remember ATC? Deduction of ATC can be claimed by individual HF, whether resident or non-resident. And non-resident or resident, individual or HF can claim the deduction for life insurance premium paid. Is it necessary that it should be paid to a company, insurance company which is in India only? Then why not this? This should also be allowed as a deduction under ATC, no? So take the deduction of this under ATC. She is going to get this deduction under ATC. Everyone understood? Now pay attention. Mediclaim premium ATD will be allowed under ATD because it is paid by account pay check. Deposit in PPF, again this will be allowed under ATC. Rent received in respect of house property at Mumbai. Don't you think that this is house property income? Property is situated in India. So no matter whatever your residential status is, the income of this property will be taxable in India. And this is rent received, guys, will be taxable under the head house property. But this will not be your house property head income. You are going to get 30% standard deduction, interest on housing loan deduction and all. There is no interest on housing loan, so take 30% standard deduction. Consider this amount as your GAV. So GAV is 60 and 30. No municipal tax paid. NAV is 60 and 30. Take 30% standard deduction. So 60,000 into 30%, 18,000 standard deduction. Then the taxable income will be 42,000 over here. House property income, yes or no? And here it will be how much? It will be 21,000 because 30% will be 9,000. So 30 minus 9 will be 21,000. This is income from house property. Now believe it or not, you have solved the entire question, guys. So far, did you find it difficult? Sure, it is that easy question. But now when you start calculating, no, see, there are many places where you can go wrong. Pay attention what I am trying to do. This is Rosie, who is non-resident. This is Mary, who is ROR. Okay. Tell me. First income from salary. For Rosie, no salary is taxable. For Mary, 10,000 salary is taxable. We have already calculated. Yes or no? For both of them, income from house property is there. For Rosie, it is 42,000. And for Mary, it is 21,000. For both of them, there is no PGBP income. No need to write. There is capital gain. Yes, long-term capital gain under section 112 taxable at 20%. And short-term capital gain under section 111A taxable at 15%. Yes or no? So how much is the long-term gain? Please tell me. 1 lakh each. And short-term gain is 20,000 and 2,50,000. Okay, no? So it is 20,000 and 2,50,000. Long-term gain for both of them is 1 lakh. Getting it? Is there any IFRS income? No. So no need to write. Do you have three heads income? Salary, house property and capital gain. Okay. In capital gain, there are two types of gains. Long term and short term. Any other income? Any other income? Sure? Okay. Now do one thing. We'll total. You are going to get GTI. Gross total income. First case, it will be 1,62,000. Second case, it will be 10,000 plus 21,000 plus 1 lakh plus 2,50,000. It will give you 3,81,000. So far, no problem. It's simple. Now please pay attention. Will you take chapter 6A deductions? Yes. But if you directly take chapter 6A deduction, the answer will be wrong. Why? Because your total income includes special incomes. From that you cannot take chapter 6A deduction. This was the first place where you could have gone wrong. So avoid taking chapter 6A deduction directly from GTI. First ask yourself, does my GTI include any special income? Yes. So what I'll do, these two incomes are there now in my GTI. I will reduce these incomes from my GTI. Because I don't want to take any chapter 6A deduction out of these incomes. Whatever balance GTI will be there, from that balance GTI only, chapter 6 deduction should be taken. Okay, no? So balance GTI is 42,000, sir. Sir, balance GTI is 42,000. And here it is 31,000. Are you getting it? What is happening? Now from this you are supposed to take chapter 6 deduction. And once the deductions are taken, again I will add back the long term gain and short term gain, because I have to show that in my total income. Yes or no? So balance GTI, this minus chapter 6A deductions. No. First is ATC and second is ATD. Only two deductions are there, no? ATC and ATD. Okay, no? ATC and ATD. If I calculate ATC for Rosie, it is 42. Can I claim 42? Yes. First what I will do, I will close this and say that this is A. And then I will total this also. See, ATC for Rosie it is 40. For Mary, how much ATC? 10,000 plus 20,000. It is 30,000. Yes or no? So it is 30,000. For Rosie there is no ATD, but for Mary it is 20,000, 25,000. Right or no? So total 40,000 deduction, chapter 6 deduction, and total 55,000 chapter 6 deduction. Now A minus B, if I will directly do now, what will happen? First will be having 2,000, that is okay. But 31,000 minus 55 if I do, that means I am taking more deduction as compared to my balance GTI, which is not possible. So my deductions has to be restricted to the extent of my balance GTI. Okay, no? So what I'll do? A or B, whichever is lower. So A or B, whichever is lower, 40,000. A or B, whichever is lower, 31,000. Okay. So this is allowable under chapter 6A. So 40,000 and 31,000. So out of 42, take 40. What will remain? 2,000. Everyone got this? Out of 31, take 31. What will remain? Nil. This is balance GTI after chapter 6A deductions. Got it, sir? Now what I will do? See. LTCG, STCG, which is there. This is copy and this is paste. Now, can I calculate my total income now? Yes, sir. Add 1,22,000 and this will be 3,50,000. Now they have told you to calculate the tax liability also, no sir? Sir, on the first there will be no tax because the total income is less than, I will give you a tight slap, if you will say like that. On the total income, from the total income, you will separate special incomes. On special income, special rates. So wait, now the tax liability calculation, see. Tax for Rosie I am doing. Now this tax calculation I am doing for Rosie. What was her total income? 1,22,000. Can I say out of this LTCG under section 112 is there? How much? 1 lakh, which is taxable at 20%. Out of this STCG under section 111A is there, amounting to rupees 20,000, and the balance total income is 2,000 only. What will be the basic exemption limit? it will be 2,50,000 because both of them are not senior citizens. Okay, no? So 2,50,000. Can I have unexhausted basic exemption limit? Yes, I have unexhausted basic exemption limit of 2,48,000. Now pay attention. Huh? Can it be set off against, adjusted against LTCG? Yes. Can it be set off against HTCG? Yes. But for that you need to be a resident individual or HUF. Madam Rosie, you are a non-resident. Therefore, this unexhausted basic exemption limit will be ignored. This cannot be adjusted against your long-term gain and short-term gain. Got it? So this was the place where you would have committed the mistake. Okay, no? So on long-term gain, apply directly 20%. On short-term gain, directly apply 15%. So this will be 20,000 and this will be 3,000. And here the tax will be nil. So do you have tax on total income? Yes, sir. 20,000 plus 3,000 plus nil, it will be 23,000. Even if your total income is less than 5 lakhs, you cannot claim rebate because you are non-resident. So there is no chance of claiming rebate under section 87A. Will not be allowed since assessee is a non-resident. So 23,000 will be tax after rebate, add 4%. 920. 23,920 will be the final tax liability for Rosie. Was it difficult? Done. So where you could have gone wrong? One, tax liability calculation. You could have taken unexhausted basic exemption. First mistake, no tax only, sir. Basic exemption limit is not crossed. Gone. Then and there, wasted. Then, okay, you identified. No, tax liability will come because special incomes are there. So you bifurcated like this. All of a sudden you came to know, ayyo, there is unexhausted basic exemption limit. Let me adjust. The moment you are adjusting, you are gone. Second mistake can happen here. Third mistake can happen while taking the rebate. Avoid all these mistakes. If you get 23,920, the first mistake itself was in life insurance premium, which you would not have taken. Yes or no? So there are 4 places in only one case. There are 4 places where you could have committed the mistake. Okay, please avoid all these mistakes. Next one. Now let's calculate the tax liability for Mary. Okay, what was the status of Mary? She was ROR, no? Okay. Now her total income was 3,50,000. Apply the same procedure. See, if you will calculate like this, no, you will never go wrong in your tax calculation. Okay, no? So what is your LTCG? LTCG is 1 lakh only. What is your STCG under section 111A? That was 2,50,000, sir. Now tell me, do you have balanced total income? Sir, no balanced total income. And basic exemption limit, to me also it was 2,50,000, and that completely remains unexhausted. Full basic exemption limit is unexhausted. Do you see this? Now can you adjust it against long-term gain of 20%? Yes. Can you adjust it against short-term gain of 15%? Yes. You can set it off against both. So 250 matching, you have adjusted. So on 1 lakh you will have to pay 20%. Otherwise, do one thing, out of this 1 lakh you adjust from LTCG, make the LTCG nil. So 20% tax rate income gone. Now balance 1 lakh 50 you claim from short term gain. 1 lakh will remain from short term gain. On that it is better to pay 15%. Yes or no? So out of this unexhausted basic exemption limit amounting to 1 lakh you will adjust from here. So this will be nil into 20%. Your tax will be nil. Okay, and from here you will adjust unexhausted basic exemption limit 1 lakh 50. So now 1 lakh will remain from here. On that it is better to pay 15% rather than paying 20%. So this will be 15,000. Okay, no? Now here your tax liability will be nil only. So can I say your tax on total income will be 15,000 only? Nil plus 15 plus nil. Minus, now you are going to get rebate also. How much? Either the entire 15,000 or maximum 12,500, whichever is lower. So 12,500 you are going to get rebate. 2,500 will be your tax after rebate. Add 4%, 100 rupees. So your final tax liability will be 2,600. Done, sir? This was your 10 marks question. Okay, so question number 10 done. Okay, perfect. 11 done. Now the 12th question I am doing in a while. Okay, first let me finish the other deductions. There are 3 deductions remaining. 80 JJAA. See, all the questions from computation of total income are done. Only one question is remaining in computation of total income, and 3 questions are remaining in deductions, and 3 deductions are also remaining. Okay, so let me first finish the 3 deductions. 80 JJAA. See this section, no, 80 JJAA. If you are any person, what did I say? You are any person. You can be a resident or you can be a non-resident also. You are doing a business and the books of the business are liable for tax audit during the previous year. Compulsory requirement, huh? So if you are a person doing any business during the previous year and the books of accounts of your business are liable for tax audit under 44AB, meaning that your total income from the business, your turnover of the business would be more than 1 CR. Yes or no? Do you remember tax audit provision 44AB? Have I written profession? No, I have written only business. So the deduction under 80 JJAA is not available if you are doing a profession. It is available only if you are doing a business. So all the associates doing business? No. Only those associates whose business, the books of that business are liable for tax audit. Okay. Now a person like you employs additional, meaning new employees during the previous year, meaning you are generating employment opportunities, you are generating new employment, you are helping the government to reduce unemployment. Yes or no? Hence government is very happy. Hence the income tax act is very happy. What is happening, the salary which you will give, the salary which you will give to these employees will be your PGBP expense, which we have already allowed as a deduction under PGBP head. Yes or no? So whatever salary you are going to give to these new employees, can I say that is your additional employee cost? Will you incur salary, emoluments, payments, whatever allowances you are giving, whatever basic salary you are giving, whatever amount you are spending for their benefit, entire amount which you are spending for them during the previous year, meaning their salary. In layman language, should I say their salary? So new employees employed, whatever salary given to them, additional employee cost. New employee employed, whatever salary given to them is known as additional employee cost. That additional employee cost we have already allowed as a deduction under PGBP head. That is your expense. We have allowed, no? Don't worry. We are going to allow 30% of that again under 80JJAA. So additional employee cost, 30% of this you can claim as a deduction in this year. So don't you think double benefit happening to the extent of this 30? If 100 rupees was given as a salary to these employees, so that entire 100 we have allowed, no? So out of that 100, claim 30 again. So that 30 is allowed twice, double. 30 is allowed there also as a part of 100 and 30 is allowed here also. So you are not getting deduction of 100, you are getting a deduction of 130. Got it, sir? And why the government is giving you this benefit? Because you are generating employment. Okay, no? And this deduction will be eligible. You are eligible to claim this deduction for how many years, 3 years. So the first year in which you have taken this deduction, the year after that, and the year after that. 3 consecutive years. Give employment to new employees. Whatever new employees you have employed in that year, additional employee cost of those employees will be allowed as a deduction to the extent of 30%. So this year you have employed new employees. 30% you have claimed for the first time in this year. Hello? Will you be able to claim 30% of that? Yes. Next year again you want to claim? You will be able to claim provided you employ new employees, additional employees in the next year. And the number of employees employed by you in the next year, no, should not be the replacement of old who are leaving, no. They will be over and above the total number of employees as on the last day of earlier year. So, earlier year, meaning last year, what was the number of employees? 50. Last year, last day, how many employees you had? 50. This year, out of 50, 10 are going and 8 are coming. These 8 are not new employees. These 8 have come to replace the 8 which have gone. Still 2 shortfall. This year additional employee cost will be 0. No deduction 30%. Now wait, 50 were there. This year 10 left and 18 joined. So 8 employees, because out of 18, 10 are replacements only. 8 employees. Now the total will become 58. Yes or no? If that total will become 58, then over and above 50, how many new employees are there? 8 only, no? 50 becomes 58. So over and above 50, how many employees are there? 8 only. So to those 8 employees, out of 18, out of the new 18, you choose which 8. You choose which 8. Okay, no? So to those 8 employees, whatever salary you will give, additional employee cost, 30% of that you can claim. But you cannot claim for all the 18. Huh? Got it, sir? Now this deduction will be available for 3 consecutive years. How many years? 3 consecutive years. Meaning that this year you claim, next year also you will have to claim, next to next year also you will have to claim. In between, for a single year if you are not claiming, that will not be allowed again. So for example, second year the total number of employees did not increase. So second year you could not claim. Third year you claimed. But in the fourth year you cannot say that, see, I did not claim in the second year. No, so give me the deduction. No, that is why they have said 3 consecutive years. From the first year in which you have started claiming this, 3 consecutive years. So new employees, additional employees for this year, it should be over and above the total employees of the last year, yes or no? For example, this was your new business only. So in the new business, all the employees are new only, no? So all the employees are new employees. Next year, whatever number of employees will come, no, new employees should be over and above the total number of employees as on the last day of this year. Okay. Now next to next year, total number of employees should be over and above the total number of employees as on the last day of the second year. Got it, sir? Now pay attention. 4 types of employees I am telling you. How many types? 4 types. Number 1, employees whose monthly salary greater than 25,000 per month. 2, the employees who are employed for less than 240 days in your business. But if your business was manufacturing apparels, footwears or leather, then don't see 240, see 150 days. Number 3, employees not participating in RPF. Number 4, employees whose entire employee pension scheme contribution made by government. If these employees are joining you in this year, they will not be treated as new employee. So any employee whose monthly salary is more than 25,000 will not be treated as a new employee. So we want you to employ those employees whose monthly salary is 25,000 or less. We are giving you 30% extra. Just imagine if monthly salary is higher. If monthly salary is higher, so we'll have to give you more deduction, no? And there will be no limit only. So give 25,000 monthly salary or less. Those employees will be treated as new employees. Okay, no? Second, the employees who are employed by you in this year should get minimum 240 days employment with you in this year. But if you are not employing them for 240 days, you are employing them for less than 240 days, then these employees will not be treated as new employees. And if your business is manufacturing of apparel, footwear or leather business, yes or no, then in that business, at least give employment for 150 days. If you are giving less than 150 days, those employees will not be treated as new employees, yes or no. If your employees are not participating in RPF, meaning you have not kept them permanently. If any employee you are keeping on a permanent basis, you have to compulsorily open a RPF account for them. So if they are not participating in RPF, meaning that you have not kept them on permanent basis, they are your casual employees. They are your contract laborers. Hello. So are you resolving the unemployment issue on a permanent basis or on a temporary basis? Temporary. Because you are not giving permanent employment. So even though the salary is 25,000 or less, even though you have employed them for 240 days, 150 days or more, yes or no? But since they are not participating in RPF, these employees will also not be eligible employees. Yes or no? Now, there are certain employees, see, in certain organizations, there is a requirement that both the employer and the employee both should contribute in pension scheme. So there is a government pension scheme. In the government pension scheme, both should contribute. Employer, employee, both. Employer will contribute, but the employee's contribution will go from government side. It will not be deducted from employee's salary. So we are not supposed to see which kind of organizations are there, why that is happening. No need to apply your mind over there. Okay, no? So different laws, different requirements are there. Okay. So as per the requirement of any law, if your organization is employing some employees, you and your employees both will have to contribute to employees pension scheme. You contribute, your employees contribution should not be deducted, government will make the contribution. Hello sir. So if the employees are such employees whose employee pension scheme contribution is made by the government, then these employees should not worry about their future. Okay. And we don't want you to employ such type of employees. So any employee who is a new employee should not be any one of them. If any one of these employees are there, he will not be treated as new employee. But wait, do you see employees who are covered in second point? Have you given them employment for 240 days or more? No. 150 days or more? No. So this year they will not be treated as new employees. Next year they will be treated as new employees. Provided next full year they are getting employment from you. Hello. And their salary is also not more than 25,000. This year they will not be treated as new employee, but next year they will be definitely treated as new employee. Hello sir. Provided next year they are with you. You have given them the employment in the next year and their salary is also 25,000 or less, and they are participating in RPF. Their EPS contribution is not made by the government. For next year we will count him. Okay. Now see, during the year you have employed 32 employees. How many employees? 32 new employees. Can I say out of 32, 14 employees are any of these 4 employees? Few employees salaries more than 25, few employees not employed for 240 days or more, few employees not participating in RPF, few employees EPS contribution made by government. How many such employees were there? 14. So they are known as non-eligible new employees. They are non-eligible. So whatever employee cost, additional cost on these employees were there will not be allowed to the extent of 30%, because we don't count these employees as new employees. Yes or no? So how many balance remaining? Come on. 32 minus 14. So balance 18 employees are there. Now these employees are known as additional employees or new employees. These are eligible. These are known as eligible. Now to these 18 employees, whatever emoluments given. What did I say? Emoluments. So what is the meaning of emoluments? Emoluments means whatever payments, basic given, bonus given, commission given, allowances given, hello, whatever is given to them. So any emoluments which is paid or payable to them by the employer during the previous year. But remember, these emoluments must be given by way of prescribed modes only. Only prescribed modes. So am I talking about those 14 employees? No, forget about those 14 employees. Anything given to them will not be treated as additional employee cost. Yes or no? I am talking about these 18 employees. So anything given to these new employees, eligible new employees, but has to be given by way of prescribed modes. But this emoluments will not exclude what? Exclude 2 things. Number 1, employer's contribution to staff welfare fund or scheme and lump sum retirement or superannuation benefits, termination benefits, yes or no? So see, as an employer, I have to pay this also to my employees. I have to pay this also to my employees. So will it be considered as emoluments of new employees? No, 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 no. Except these two things, anything which you give. Except these two things, anything which you give. But you have to give in prescribed modes. Hello? So emoluments by way of prescribed modes, excluding these two things, given to eligible employees will be known as additional employee cost. 30% of this you can claim. Got it, sir? Everyone? Now wait. Now, for example, you are giving allowances to your employees. Will it be counted? So you are giving 10,000 per month as an allowance. Will it be counted? Yes. Everything, whatever you are giving to your employees, everything has to be counted. But after receiving 10,000 as allowance from you, 8,000 becoming exempt in his hands. So how much will you take? Will you take full 10,000 given by you, or you will take 2,000 taxable for them? Understood my question? You have given them some salary. That salary means, let us say, some allowance you have given. So allowance is also treated as emolument, yes or no? You have given them 10,000. But 8,000 got exempt in their hands, only 2,000 getting taxable. How much will you take? As your additional employee cost of your employee, how much will you take? Will you take entire 10,000 or you will take only 2,000 which is getting taxable for them? You are not supposed to see how much is exempt to him. How much you are giving? That is your cost, no? How much you are giving? 10,000? That is your cost. Take 10,000 full amount. Take the gross amount, not the amount becoming taxable to them after taking exemption. You don't have anything to do with that, no? Have you given 10? Yes. Is 10,000 your expense? Yes. Claim that as your additional employee cost. Understanding? But remember, prescribed modes, compulsory the payment shall be made by prescribed modes. And remember, these two things cannot be given. Okay? And all the gross emoluments which you have given them, that gross emoluments you are supposed to take. Got it, sir? Now pay attention. In any year, how many? Last year, last day, 50 employees were there. So can I say they will become opening in this year 50? Current year these 50 will become opening. Out of those 50, 20 are leaving. And these 32 which are coming, no? Hello. Please pay attention. These 32 are coming, no? These are the 32 which are coming. Getting my point? So you will say, sir, 50 out of the 20 left and 32 join. Okay, no? So I am having 62. Meaning last year, last day, 50 were there. Over and above, how many are there? 12, sir. So 12 new employees. If you do such calculation, you are gone. Why have you taken 32 over here? Are these 32 your eligible employees? No, na? How many eligible? Only 18. So don't take this 32, take 18. Now add and now say. Will you get 62? No. You are going to get 48 only. This is less than 50 employees also. So this year your additional employee cost will become 0. You are not going to get any deduction under 80JAA. Hello, sir. Did you understand? But wait. Sir, only 14 had, only 15 had left, sir. Only 15 had left. How many had left? Only 15 had left. Okay. Now let us do the calculations again. Sir, only 15 had left and 32 has joined, sir. First of all, 50 minus 15 will be 35. 35 plus 32 will be 67, sir. Hello? Over and above 50, how many are there, sir? 17. So 17 new employees you are saying. Are you doing it correctly? No, wrong. Why did you add 32? Out of 32, 14 were not eligible only, no? Hello? 14 were not eligible. So how many will you take? Come on, tell me. Will you take 32? No, you are going to take 18 only. So this will become 53. So how many over and above 50? Only 3 employees. Only 3. Now which 3 out of 18 you decide? Understanding? Which 3 out of 18 that you decide? Done, sir? Should I move ahead? Wait. Now, can I say next year, opening how many employees will be there? Come on, see, this was last year, so this is this year, okay, no? This year calculation is this. Now, based on this year, tell me, next year opening will be how many employees? 53. I will give a tight slap. Next year opening will not be 53, next year opening will be 67. 53 you took for calculating additional employee cost. How many employees you had? 50. How many left? 15. How many joined? 32. So tell me, how many number of employees are there as on this year's end? 67. So next year, whatever new employees will be there, they must be over and above 67. Got it, sir? You cannot take 53. 53 you are taking to calculate the additional employee cost for this year. Apply some logic, no? If 50 were there, 50, out of that, 15 employees gone and 32 have joined. So what is the total number of employees as on the last day of this year? That is not 53, that is 67. And next year, whatever eligible new employees will come, no, they have to come over and above 67. Got it? Sure? Krishna? Okay. So this was some basic calculation. Okay. Now you have understood how the calculations needs to be done. This entire section I have given in my notes which I have provided you. You are going to read the notes properly today. Will you? Sure? Now pay attention. Very simple thing I am trying to tell you. Very simple thing. There are few conditions to claim this 80JJAA deduction. The business should not start from splitting up or reconstructing the existing business. Genuinely, fair enough, no? If you will split the existing business and start a new business and say that I am giving new employment, that is wrong. Already existing business you are doing, so whatever employees are there are not newly employed, no, they are already employed. So that company which was doing two business, one business is split and a new company started, and on the name of new company this business is done. So now that new company cannot say even we want 80JJAA. Why? Because you have got the existing business. In that existing business, existing employees have come. For those existing employees, we cannot give you 80JJAA. Now one company X Limited, one company Y Limited, both are merged and new company is formed, XY Limited. So XY Limited cannot claim 80JJAA saying that we have started a new business. Bloody, you are yourself new assessee. The business you are doing has not been started. The employees, they have not been employed for the first time. They are already your employees. How can you take 80 JAA for them? Employ new employees. No, we are going to give you. But the business cannot be started with splitting up or reconstructing the existing business. Yes or no? This is the first requirement. And second requirement is the assessee who is going to claim 80 JAA deduction, no, he will have to go to his chartered accountant. Say thank you. And he will have to get a chartered accountant's report prepared in a prescribed format. Just like your tax audit report is made, no, just like that there is a practicing CS report in prescribed format for 80 JAA, where the chartered accountant will, certify that how many number of employees were there, how much salary you are giving, all those things relating to 80 JAA will be given in that CS report. Okay, no? And based on the report prepared by the CA, you are going to get this 80 JAA deduction. So if you are a chartered accountant doing such kind of work for any of your client, will you charge any money from your client? So say thank you. Opportunity for you to earn income, no? Okay. So this was 80 JAA. Okay. One question is there on 80 JAA that we are going to solve. Come on. That was your question number 17. Yes, come to question number 17. Very easy question. Very, very easy. Okay. Till 16 we have completed everything. In your deductions chapter we are supposed to go, huh? Deductions chapter number 6. Computation of total income. All the questions are done. Only one question is remaining. Computation of total income. Only one question is remaining, guys. Now come to the deductions chapter. And in the deductions chapter, illustration number 17. Please see here. Everyone. Mr. A has commenced the business of manufacture of computers. Wait. What he is manufacturing? Is he manufacturing apparels? No. Is he manufacturing leather? No. Is he into footwear manufacturing business? No. Manufacturing anything else. So in this business, new employees must be given employment for at least 240 days or more. But if the business was manufacturing of apparels, leather or footwear, then 240? No, 150. Then see 150. Okay, no? But in our case, we will see 240. Okay, next one. The business was started on 1st April 2024. Can I say this year the business is started? The business is a new business. And in this business, whatever employees I will have, all are new employees only, additional employees. But don't you think all are not eligible? All employees are new. All employees are additional employees, but all are not eligible. Out of them, some employees will get more than 25. Some employees will not participate in RPF. Some employees will be given the employment of less than 240 days. Yes or no? Some employees EPS contribution will be made by the government. All such employees I will have to ignore. Understanding, no? Same thing I have to do here. Wait, see, 350 new employees are there. So all the employees are new employees. Out of that, 75 employees you have employed from the beginning of the year. So 75 employees will be working with you for 240 days or more. 1st April to 31st March. Employment more than 240 days only, no? And they are regular, meaning they are participating in RPF. See, read this. Regular employees participate in recognized provident fund while casual employees do not. So these 75 employees employed from the beginning, meaning you are giving them employment for more than 240 days. They are regular, meaning they are participating in RPF also. And see, their monthly salary is less than 25,000. So 24,000 from the April month you are going to give them. April to March, 12 months you are going to give them 24,000. So 24,000 into 12 will be 2,88,000 salary which you are going to give to one employee. Yes or no? Likewise, how many employees are there? 75 into 75. So 2 crore 16 lakh rupees will be your employee cost for these 75 employees which are eligible employees. Yes or no? Now come to the next 125 employees. 125 employees employed in May. So from May to March they are going to work for more than 240 days. Yes or no? They are regular, meaning they are participating in RPF also. But look at their salary. Is it more than 25? They are not eligible. It is more than 25,000, no? So they are not eligible, forget them. Then next one, how many employees? 50 employees. Have you employed them in August? So from August 24 to March 25, they are going to work for 240 days or more. Hello sir, if you will count, no, from August to March, it will be 240 days or more, okay, no? But they are casual, sir. Even if I am giving them the salary of less than 25,000, but since they are casual, not participating in RPF, I have to ignore them also, because they are also not eligible. Now talk about these 100 employees. Can I say these 100 employees? These 100 employees are employed on 1st September 2024. So can I say 30 days of September, October 31, November 30, December 31, January 31, February 28 and March 31. 212 days, sir. 212 days. Still less than 240. Just because of this. Otherwise, see, they were participating in RPF also. Their salary was also less than. So, for me, how many eligible employees are there? 75. 75, how much salary I am giving? How much emoluments I am giving? 2 crore 16 lakh. For that, 30% I can claim right now. Please check. 2 crore 16 lakhs. Sir, 2 crore 16 lakh, 30% of that. Please calculate, please calculate. This will be the amount. This will be my 80 JJAA deduction for this year. And next year, if I want to claim, no, this same deduction, next year I want to claim, I will have to employ new employees over and above 350. I cannot say over and above 75. Over and above 350. Total number of employees as on the last day, 350. Over and above 350, whatever new employees will come in the next year. Okay, no? For them only, I'll be able to claim additional employee cost to the extent of 30%. Got it, sir? Now pay attention. Pay attention. What would be your answer if Mr. A has commenced the business of manufacture of footwear instead of computer? Now I will not see 240. I will see 150 only. So if I see 150, then see, still this and this will not be eligible. But can I say now this will be eligible? Because from 1st September till 31st March, 212 is more than 150. So emoluments given to them, 24,000 I will give them. But wait, 24,000 for one employee I will give from September to March, not for 12 months. These 100 employees are joining me in September. So will I give them salary for 12 months or only 7 months? So 24,000 for 7 months only I will give, no? So 24,000 into 7 will be 1,68,000 per employee. How many employees are there? 100 employees. 1 crore 68 lakhs. So now 1 crore 68 lakhs plus 2 crore 16 lakhs will be 3 crore 84 lakhs. Now I will take 30% of that. It will be 1 crore 15 lakh 20,000. Are you all getting it? 1 crore 15 lakh 20,000. Can you see? See, this type of question, if they will ask you in the exam, it will be around minimum 2 marks, MCQ. Was the section easy? Sure. Now pay attention, 2 more sections I am supposed to discuss with you. In fact, 3 sections I am supposed to discuss with you. Okay, now? See, now 80 QQB. If you are resident plus individual, but you must be an author or a co-author. Author or co-author. What you will be doing, author? You will be writing books, no? So you are an author or a co-author will writing books. What type of books, sir? Artistic, scientific, or literary nature only. If any of these books you are writing, so definitely you would have taken the copyright of this book and you would have given the copyright to be used. You are allowing the use of copyright. You are allowing the use of your copyright to whom? To the publisher. Are you selling the copyright? No. You are telling the publisher, take this copyright. I am assigning this copyright on your name for 5 years. Use my copyright, use my book content, and you publish the book. Am I transferring my copyright or I am just giving for some time to be used? Yes, I am allowing the use of my content. So now my content you publish, you sell the book. You sell the book, you publish the book having my content. Now what that publisher will do? Publisher will use my copyright, use my content, and he will publish the book from my content. Yes or no? From that publisher will earn income. Publisher will publish books and these books will be sold. He will earn income. Who will earn income? Who will earn income? Publisher will earn income, no? Out of that income, he is going to give you something. He is using your using your copyright to publish these books. Yes or no? From which he is earning income. So out of that income, he will give you something for use of your copyright. That is known as your royalty income. Sufficient. On this royalty, show it taxable in your GTI, claim 80QQB deduction. That's it. But the royalty which you are earning must be from these books. Only then that royalty will qualify for 80QQB. So if you are earning this royalty, see, this is your royalty income. Royalty income given to whom? Royalty income given to whom? To this author. So this author earning this royalty and showing this royalty taxable under GTI, under his GTI, yes or no? Just sufficient. This is sufficient. On this royalty, show it taxable in your GTI. Whenever you are calculating your GTI, in the calculation of your GTI, show this royalty taxable as your PGBP income. That's it. And come to us. We are going to give you deduction under 80QQB. But if you write any other book, which is not an eligible book, from that if you are earning royalty, you will have to tax it under your GTI. But that royalty will not qualify for 80QQB. Under 80QQB, which royalty from your GTI will come? From your GTI. Hello. From your GTI, only the royalty which you are earning from these books will come. Understanding? So if you are earning any other royalty, show it taxable in your GTI. But that will not come for 80QQB deduction. So I told you, no, there are certain deductions which are available on earning a specific type of income. If you are earning interest on savings deposit, show it taxable in your GTI and then later claim it under 80TTA. If you are earning interest on deposits and if you are a senior citizen, show it taxable in GTI and claim it as a deduction under 80TTB. So now they are saying that if you are a resident, author or a co-author, yes or no, you are earning this kind of royalty, show it taxable under your GTI and claim that royalty as a deduction under 80QQB. But wait, how much royalty you are going to claim under 80QQB? So the entire royalty which you have shown over there, entire royalty which you have shown there, okay, gross royalty, gross. If that royalty is lump sum, lump sum royalty. Then full amount of that royalty will qualify for 80 QQB. What did I say? Full amount of. For example, you have told that take my copyright for 5 years and give me a lump sum amount of royalty. This much amount for this year, 2 lakh for this year, 3 lakh for this year. Lump sum amount you are asking. Okay, no? So that lump sum amount of royalty which you are asking, that lump sum amount was taxable by you. Bring that entire lump sum amount here under 80 QQB. Now, while claiming, while calculating your GTI, have you claimed any deduction out of this royalty? You must have claimed the deductions out of this royalty. To earn this royalty, whatever expenses you have incurred, that entire expenses you have claimed as a deduction, no? Reduce those expenses here. So all the expenses claimed while calculating GTI, okay, reduce that. What will be there, you know? This was your gross amount minus expenses claimed, net eligible royalty. What, sir? What? Net eligible royalty. Net eligible qualifying royalty. You can say net qualifying royalty also. You can say net eligible royalty also. Okay. This net eligible royalty or maximum 3 lakhs. Whichever is lower, that will be allowed as a deduction. First of all, are you earning royalty in lump sum? Yes. Have you shown entire lump sum royalty in your GTI? Yes. Bring that entire here. But from this royalty, whatever deduction you have claimed, no, whatever, that entire deduction you reduce. And whatever net qualifying royalty will remain, no, that only we are going to allow. Because why do we allow that same amount again? We are going to allow only that royalty which is remaining after allowing the deduction. Yes or no? That is your net eligible royalty. But we will allow it to the extent of maximum 3 lakhs. Not more than that. So what if lump sum royalty received by you was 4 lakh rupees? Show that 4 lakh. But from there, you have already claimed 1,20,000 rupees of deduction. So how much you have shown there? 2,80,000. Bring that 2,80,000 over here. Hello? 2,80,000 or 3 lakh, whichever is lower. 3 lakh, no, 2,80,000 will be allowed. Understanding? Sure. Wait, this is, I am talking only about lump sum royalty, right now. I'll be talking about other royalty also, but first learn this thing. Okay? Now pay attention. Tell me one thing. If this royalty is coming from India, meaning the publisher is in India and you are earning this royalty from India, then there is no problem, the calculation remains same. Okay. Now if this royalty was supposed to be coming from outside India, is it possible that the royalty is coming from outside India? So remember, whatever lump sum royalty which you have shown in your GTI, please concentrate what I am doing. Only then you will understand. If the royalty shown by you in your GTI, gross royalty, was supposed to be coming from outside India because the publisher was outside India, so definitely the entire royalty income which is supposed to come from outside India, you have shown taxable as your income. Qualify that fully if that royalty you have received in India within 6 months in convertible foreign exchange. 6 months from the end of this year. So end of this year, meaning end of the financial year 24-25, within 6 months, on or before 30th September, that entire royalty should come to India, should be received in India in convertible foreign exchange. So how much was the royalty? 4 lakh, no? Hello sir, 4 lakh, no? If entire 4 lakh is received within 6 months, then qualify 4 lakhs. Reduce 1,20,000. 2 lakh 80 or 3 lakh, whichever is lower. Hello, sir. But out of that 4 lakh, you have received only 3 lakh 20,000 within 6 months. 80,000 you have not recovered. Forget that 80. We will not qualify. No. 4 lakh was supposed to be coming from outside India within 6 months from the end of the financial year. Did you receive the entire 4 lakh? No. So first 4 lakh will be taxable as your GTI in your calculation of your GTI. Out of that 4, under 80 QQB, how much you will bring? Only 320, which you have received in India within 6 months. Now from that 320, how much deduction you had claimed? 120, no? Reduce that 120. How much remains? 2 lakh. Claim that 2 lakh only. That's it. 2 lakh or 3 lakh, whichever is lower. Got it, sir? Everyone? Now, see, if the royalty, if this royalty is lump sum, then what you can do? You have to do this calculation. Everyone? Hello? If this royalty taxed under the GTI was lump sum, then you are supposed to do this. But is it possible that the royalty which you are showing in GTI was received by you as a percentage of selling price? You have told your publisher that, see, publisher, hello, take my copyright for use, okay, but I don't want a lump sum royalty. No. From my copyright, whatever books you will print and sell, whatever books you will publish and sell, the sale value of that book, I need some percentage as my royalty. Hello? Getting my point? So how much royalty you are getting? Some amount of royalty you are getting, but that some amount is not lump sum amount. This amount is a percentage of selling price which you are getting as a royalty. So for example, the sales made by the publisher was 20 lakhs and you were supposed to get 12% of that. You were supposed to get how much? 12%. So 20 lakh into 12% will be 2 lakh 40. So how much amount you have calculated? 2 lakh 40. 2 lakh 40 you have taken in GTI. It is a percentage of selling price. Entire 2 lakh 40 you qualify. Because the percentage is 15% or less. Percentage is 15% or less. Then entire royalty will qualify. Minus the expenses which you have already claimed. Okay, no? Then whatever balance will remain, that balance will be net eligible royalty or 3 lakh, whichever is lower. Okay? But wait. You are getting 5 lakh rupees of royalty. 5 lakh. And this royalty you are receiving at 20%. So in your GTI, will you show 5 lakhs? Yes, show. Because 5 lakh is your income, you have to show it taxable. Show entire 5 lakhs in your GTI. But this was received at what rate? 20%. A rate which is higher than 15%. Hello? Out of this, maximum 15% can only be taken in 80 QQB. So if 5 lakhs was 20%, so divide by 20, multiplied by 15, only 3 lakh 75 can be taken in 80 QQB. So tell me now, 5 lakh was coming at what rate, sir? It was coming at 20%. At the rate of 15%, how much you should get? 3 lakh 75. So excess royalty over and above 15% which was there, no? You have to tax it. That 125 also will be taxable, 375 will also be taxable, entire 5 lakh will be taxable for you. But under 80 QQB, you cannot bring that 1 lakh 25. You have to bring only 375 out of 5 lakhs. Maximum this much you can bring under 80 QQB. Hello, sir. Now, how much expense you have claimed from that 5 lakh? How much expenses you have claimed? You have already claimed 1,50,000, reduce that 1,50,000 from here. This will qualify minus 1,50,000. So 375 minus 1,50,000 will be 2,25,000. This 2,25,000 will be allowed as a net qualifying royalty subject to maximum 3 lakhs. Will you be able to do such calculations, everyone? Hello? Sure, no? Now pay attention. What if this gratuity was supposed to come from outside India? This entire 5 lakh was supposed to come from outside India. You have to receive this within 6 months from the end of financial year. So if 5 lakh entirely received, then also 375 will qualify. Hello? What if you have received 4 lakhs only? Then also 375 will qualify. If you will receive entire 5 or more than 375, whatever you will receive, but we are not going to qualify more than 375, no. So if you have received that entire 5 lakhs or any amount which is more than 375, within 6 months you have received. So you qualify 375 only. But you have received only 3 lakhs within 6 months. We were qualifying 375. This also you have not received within 6 months. How much you have received? Only 3, no? So out of 375, qualify 3 lakhs only. Minus the expenses, 1,50,000. So how much remaining? 150 or 3 lakhs, whichever is lower. Got it, sir? This is your 80 QQB. Now if you will solve the question now, you will come to know that how easy this was. Come on. Question number 18. Please pay attention. Question number 18. Mr. Akash earned royalty of rupees 2,88,000 from a foreign country for a book authored by him being a work of literary nature. Please be very careful. Literary nature, meaning the book is eligible book. Either it is literary, artistic or scientific nature. So book is literary nature. Royalty of 2,88,000 is coming from outside India. You have to make sure that this entire royalty is received within 6 months from the end of the financial year. Yes or no? Now the royalty is at 18% of value of books. Ayyo, sir, this 2,88,000 no is at what rate? 18% rate, sir. So now can you calculate if at 15% how much would have been royalty? If 2,88,000 is at 18%, so divide by 18 into 15. How much should have been your royalty? 2,40,000. In your GTI, no friends, entire 2,80,000 you will show taxable. 2,88,000, entire 2,88,000 you will have to show taxable. But out of that 288, under 80 QQB, how much you will bring? How much maximum you can bring? You can maximum bring 240. Any excess over and about 240 will be ignored, will not be considered for 80 QQB. Yes or no? Hello, sir. Now wait. Now, expenditure incurred by for earning 40. So definitely, when you would have shown your gratuity 288 taxable, at that time you would have already claimed this 40,000 as deduction. So when you will show this 240 under 80 QQB, that time also you are supposed to reduce this 40. Because net qualifying royalty, whatever amount of expense you have already claimed as deduction, that will not be coming under 80 QQB. Reduce that. Okay, no. So how much is coming? 240. That is to come. But out of that, 40 will be reduced. Only 2 lakh will be net qualifying royalty. But wait. Is this royalty 2,88,000 coming from foreign country? If entire 288 received within 6 months, then 240 will qualify. If 2,50,000 is received within 6 months, then also 240 will qualify. Hello? But how much is coming within 6 months? Check. 230. Bloody, you are not receiving this 2,40,000. Then how do we qualify this 240? How much we will qualify? How much will qualify? Only 230. So this 240 will not qualify, 288 not qualify. Why? Because it is at a rate which is higher than 15%. So only the royalty to the extent of 15%, that is 240, can maximum qualify. But that also will not qualify because within 6 months you are receiving less than this 240. So whatever you are receiving 230, that will qualify. So now your gross qualifying royalty is 230. How much expense you have already claimed as deduction? 40. Reduce that, you are going to get 190. 190 or 3 lakhs. Whichever is lower. 1,90,000, sir. That is your deduction under section 80QQB. Sir, please check the final answer, sir. Very difficult to know. Now, if you have understood 80QQB, no, 80 RRB is a piece of cake for you. Now see, if I'll start writing, you will understand. This is resident. This is individual. He is inventor. I am not talking about electric inverter. I am talking about inventor. He must be inventing something new. And being the first and true inventor of anything, he would have taken the patent. So the inventor is doing some invention, something new he is finding out. Okay, now, and that invention, for that invention, he gets the patent registered on his name. He gets that invention registered on his name. So whenever an invention gets registered on your name, you are given a patent. So the person who is a patent holder, who is the inventor, is known as patentee or co-patentee. First and true inventor will be given what? The patent on his name. Okay. Now, what this patentee or co-patentee will do, you know? He will allow the use of his patent to some other person. See, this some other person will take the patent from him. Why? Because now this person will use such patent to manufacture or produce the goods or products which are invented by the inventor. So the goods or product which you have invented, no, which you have registered on your name, patent, give that patent to me, I will use that and I will commercially produce at a very large scale. Understanding? So whatever invention you have, that invention is your property. Okay. Now that invention which is your property should be commercially exploited by you. Nobody should copy this. Hence you have got it registered on your name. Now if someone wants to make something like this, he will have to take the patent from you. Please give us your patent so that we can use it. So some company is coming, huge company is coming, and they are asking from you your patent. Are you selling your patent? No. For 5 years, take the patent, use my patent and manufacture this item, manufacture this good and sell. So this person this some other person will use such patent, manufacture or produce goods or products, and he will sell it, and he will earn income, huge income by manufacturing, selling, huge income, manufacturing, selling, huge income. So out of this income, he should give you something for use of that patent, no? So out of that, he is going to give you what? He is going to give you royalty. Royalty. This is the royalty for use of patent given by any person to the inventor. Inventor's income taxable in his GTI. So this royalty will be shown as your income in your GTI. Yes. Are you going to show this royalty as your income in your GTI? Yes, sir. Are you going to show it? Yes, you are going to show this as your income. Now this royalty can be lump sum, this can be monthly amount, this can be percentage, it can be any amount. You have to show this taxable. Now the amount which you have shown taxable, that entire amount you bring under 80 RRB. There is no restriction like 15% should be there. This entire amount which you have shown, no, entire amount you can qualify under 80 RRB. That will be your gross qualifying royalty. And now out of this, whatever amount you have taken as a deduction, no, related expense, that you reduce. Net qualifying royalty. Net qualifying royalty or 3 lakh rupees will be allowed as a deduction under 80 RRB. Done. Sir, 80 QQB was more complicated than this. This is more easier. Why? Because you have understood 80 QQB. Wait, if this royalty is coming from outside India, same. Within 6 months, receive in India in convertible foreign exchange, then to that extent it will qualify. Any royalty which is supposed to come from outside India, if not received within 6 months, will not qualify. Not now, not later also. Not now, not later also. Convertible for it has to be convertible foreign currency. Without that, it will not be qualifying only. Okay. So in the convertible foreign currency you bring it, and then the amount of royalty will qualify. Okay, sir. Now pay attention. Pay attention. They are talking about royalty income shown in the GTI of patentee or co-patentee. For this royalty only 80 RRB deduction is available. But don't you think sometimes you sell your patent? So by selling your patent, whatever income will come to you, that will not be your royalty income, that will be your capital gain income. Even if you show that income in your GTI, no, it will not qualify for 80 RRB because that is not the income which you are earning by allowing the use of your patent. That is an income which you are earning by selling your patent, transferring your patent. For that, you are not going to get any 80 RRB deduction because that is your capital gain income, not in the nature of royalty. Now, don't you think that this manufacturer will also earn income by using the patent only? But for him, whatever income is coming, no, that is not his royalty income. Yeah, that is his PGBP income from sale of manufactured items. So any income which you are earning by selling the manufactured item or manufactured goods, that is your PGBP income, not in the nature of your royalty, even though these manufactured goods are manufactured by using that patent. So patent use is involved. By using the patent, you are manufacturing goods, and those goods which you are selling, income is generated by using the patent only. But that income is not in the nature of royalty in your hands, no. Are you the patentee or co-patentee allowing the use of your patent to someone and earning income? No. Then you cannot claim this income under 80 RRB. We are talking only about The patentee or co-patentee who has allowed his patent to be used by someone else, and for his patent which someone else is using, he is getting some income. That royalty will only be allowed under ATRRB. Will you remember? This was the deductions completed. All the deductions are done and dusted. Okay. Now all the questions are also solved. Now there is only one section remaining. What section I'll tell you? That is 10 AA. Now once we are going to do this section, no, after that two questions. One is computation of total income. In that chapter one question is there, and one question in this deduction chapter. So those two questions we'll be able to solve only after doing 10 AA. Very easy section. This is also very easy section. You will understand very, very quickly. But this we cannot do today. We are going to do tomorrow. Okay. So we'll meet tomorrow.